It's a scandal that's rocked the world of business. Some of the richest corporations on the planet using loopholes to avoid paying their fair share of tax. Cash-strapped governments looking for revenue are cracking down on multinationals to pay their taxes in the countries where they operate. Public opinion is turning against companies like Amazon and Starbucks who've dodged high tax bills in the U.S. And France is now seeking more than $1.7 billion in unpaid taxes from Google. But these companies say they're being unfairly victimized, and their tax minimizing strategies are entirely legal. There is a difference between tax evasion and avoidance. Evasion is the illegal non-payment or underpayment of tax. Avoidance is the arrangement of one's financial affairs to minimize tax liability within the law. Google and other tech giants use avoidance, and this is how. The U.S. company is based in California, but runs its overseas operations in Ireland, which offers a low corporation tax. That's where nearly all international ad sales go. Royalties are then paid to Google's subsidiary in the Netherlands with a low tax because it's another EU country. That revenue is then shuttled to Google's Irish office in Bermuda, another tax haven. Last year, Google moved over 10 billion euros without paying tax. The funds are invested back into Google's headquarters in Dublin, a tax move known as the Double Irish. All that has allowed Google to enjoy a 6% tax rate for its overseas sales. Companies like Facebook, Microsoft, and McDonald's have all used similar strategies, which governments are only just beginning to wake up to. When it comes to fighting multinational tax avoidance, politicians are singing from the same hymn sheet.
In the end, it's about fighting inequality, because it's insufferable to see big groups escaping from this while small and medium enterprises are obliged to pay.
But there's a growing chorus of voices arguing that, in fact, corporations shouldn't pay tax, that taxing companies hits the pockets of employees hardest, and that shareholders should be the ones paying tax on earnings. There's also a fear in countries like Ireland and Bermuda that stricter rules will scare away investment. Meanwhile, companies are battling governments in court, and countries are racing to close down tax avoidance schemes. Ireland has already pledged to phase out the double Irish tax loophole by 2020. But with trillions of dollars at stake, that gives some of the world's smartest people 5 years to find another one. Sandra Gatman, The Newsmakers.